Most of the conversation around London property right now is either extremely pessimistic or unrealistically optimistic. But very few people are actually looking at the numbers. So in this video, I want to walk through what the London property market actually looks like in 2026, looking at transaction volumes, supply, pricing, and the broader economic environment. Because everyone seems to be asking the same question right now. Is the London property market about to boom again, or will we continue in this prolonged buyer's market? If you read the headlines, you'll see two completely different narratives. Some commentators say that London is resilient and prices are holding up, whilst others say demand is collapsing and prices are about to fall much further. So today I want to cut through all of that noise and look at what the data actually tells us. Let's start with the transaction volumes. In January 2026, the number of prime London property transactions was down 30.2% compared with the same time last year. That is a significant drop in activity. And if we compare this with what was normal before the pandemic between 2017 and 2019, let's say, transactions are still around 20% lower than the historical average. So what does that mean in practical terms? It essentially means fewer buyers are completing transactions right now. Whilst properties are still being viewed and deals are still happening, the overall pace of the market is much slower than normal. Now for the second major shift, let's take a look at the supply side. The data suggests that whilst demand has weakened, the number of properties coming to market has actually increased. New instructions, meaning new listings, are 2% higher than last year and almost 30% higher than the pre-pandemic average. In fact, January saw the highest number of January listings since 2016. So again, we have a market where more properties are being listed, but fewer buyers are purchasing these properties. And whenever that dynamic appears in any market, prices tend to come under pressure. Now let's look into the pricing. Across prime London, average achieved prices fell by 5.6% year on year. Interestingly, prices are now also around 5.6% there below pre-pandemic average levels. So despite the surge in property values during the 2020-2021 period, much of that growth has been reversed in the prime London market. Another stat that stood out for me is the discounts. The average discount from asking price is now 10.3%, and more than half of all properties sold had at least one price reduction before finding a buyer. That's a very different dynamic to the pandemic years where properties were selling at or above asking price. Another important factor here is interest rates. As of March 2026, interest rates are still considered moderately high, although they have started trending downward. The Bank of England held the base rate at 3.75% in February, which is lower than the recent peak of 5.25% in 2023-2024, but that's still significantly higher than investors became used to during the ultra-low interest rate era. And this matters enormously for property investors, because higher borrowing costs mean that the deals which may have worked financially a few years ago simply do not work anymore. In fact, one of the biggest mistakes I see investors make is assuming that future price appreciation will compensate for a weaker deal today. So London property in 2026 is neither the guaranteed wealth engine it appeared to be, but nor is it the disaster that some headlines suggest. What the numbers actually show is that it's a market that's slower, more price sensitive, and far more dependent on disciplined analysis. But interestingly, these are often the exact conditions that create opportunities for investors who understand exactly where we are in the cycle. Hopefully you found this market update useful, and I'll see you on the next one.